Welcome to this explainer. All right, let's just jump right into it, because today we are looking at a market phenomenon that literally only pops up about once every 10 years. Now, I know when you turn on the news during a financial downturn, it totally feels like the sky is falling. But what if I told you that market crashes aren't actually the end of the world? What if they're actually a predictable, once-in-a-decade opportunity to build absolute life-changing wealth? Well, today we're going to break down exactly how that works using real historical data and real numbers.
600%. And no, this isn't from some super risky crypto bet or a lucky day trading streak. This is the incredible return regular people made by doing something amazingly simple, investing $10,000 into the S&P 500 during the massive 2009 crash. When the market dropped to a truly terrifying 670 points, the folks who actually bought in, they watched that initial 10 grand just absolutely skyrocket to over $70,000 by 2021, just by buying when literally everyone else was selling.
So that brings us to the big central question of this explainer. What exactly should you do when fear completely takes over, the news is predicting absolute doom, and the stock market goes into a free fall of 30% or more? I mean, do you hide your cash under the mattress, or do you run straight toward the fire?
To answer that, we really have to anchor our entire strategy on this incredibly famous maxim from Warren Buffett. He said, "Be fearful when others are greedy, and greedy when others are fearful." It's a quote we've all heard a million times, right? But very few people actually execute on it. When you feel that visceral, sick-to-your-stomach gut fear during a crash, when you're thinking, man, maybe I should just stay in cash, that feeling, that is actually your ultimate buy signal. That is the exact moment the world's greatest companies go on sale. All right, let's move right into Section 1, History of Market Crashes and the Predictable Cycle of Panic.
So, we have to look at the historical data here to prove that market doom is absolutely not a unique world-ending event. It is a cyclical, highly predictable pattern that has repeated for the last 100 years. If we just map out the timeline of chaos, a super clear pattern emerges. Back in 1987, Black Monday saw a 22% drop in a single day. People literally thought capitalism was over. But within 5 years, the market doubled. Fast forward to the 2000 dot-com crash. The NASDAQ fell 75%. Everyone said tech was dead. Yet Amazon, which dropped to just $6 a share, is now worth thousands. During the 2009 financial crisis, you could literally buy Apple for $12. And of course, the 2020 COVID crash saw a terrifying 34% drop in just 23 days. Over and over again, it's the exact same story. Panic, massive sell-off, recovery, and then boom, new all-time highs.
Now, what's really fascinating is the math behind the aftermath. Historically speaking, a major correction of 20% or more happens roughly every 10 years. And the average time it takes for the market to fully recover? Just 2 to 3 years. But here's the kicker. Historically, investors who hold their nerve and hold their investments for 10 years after a major crash see an average return of 200%. It is just a staggering wealth-building mechanism.
So if the math is so incredibly clear, why on earth doesn't everyone do it? Well, that brings us to Section 2, the psychology of markets, fear versus value.
We really need to understand exactly why company fundamentals often survive perfectly fine even while their stock prices temporarily collapse. There is a totally stark divide in how human beings react to these moments. On one hand, you have the crowd's reaction. Human psychology is completely driven by fear and greed. During a crash, the crowd panics, they hoard cash, and they sell their investments at a massive loss. But then you have the contrarian's reaction. They look at a 30% drop not as some massive catastrophe, but as a super rare opportunity. They keep their emotions in check, they buy into index funds, and they calmly hold on.
So the absolutely crucial concept here is understanding fear-driven pricing. This is basically when extreme market panic drives a perfectly healthy company's stock price way below its actual fundamental value. Just think back to 2009. Apple's stock dropped to $12. Did iPhones suddenly become completely worthless? No way! People were still buying them. People didn't stop shopping on Amazon either. In fact, they probably shopped there more, just to save money. Fear temporarily broke the market's pricing mechanism, but the companies themselves, they were perfectly fine.
All right, let's move into Section 3, real stories of regular people, and why you definitely don't need a finance degree to make this work.
I honestly love this part of the explainer because it completely proves you don't need a degree from Harvard to pull this off. Take Veronica, for example. She was a 32-year-old teacher in Ohio back in 2009. When the market crashed, literally everyone told her to wait, warning her that she'd lose everything. But you know what she did? She looked at the historical data, completely ignored the panic, and confidently put her $15,000 of savings into a totally boring S&P 500 index fund. She didn't day trade, she just held. And by 2020, that investment calmly grew to over $90,000. And then we have Alex, a 45-year-old construction worker from Texas. In 2008, his portfolio crashed hard. But instead of selling out, he did something his friends thought was completely insane. He mathematically calculated that he could easily pay back a $10,000 home equity line from his stable income, and he injected that cash right into the crashed market. That brought his total invested to $35,000. Because he took that calculated risk during absolute peak fear, that money turned into over $250,000 by 2021 and allowed him to retire at age 58. Then there's this number, $30,000. This is from the terrifying 2020 COVID panic, right when the world was shutting down and all the talking heads were predicting a decade-long recovery. Jessica, a nurse in California, bravely took $30,000 of her cash savings, money that was just sitting there, earning zero interest, and completely ignored her friends telling her she was throwing it all away. She simply bought broad index funds like VO and VTI. And what happened? By early 2022, her money exploded to over $65,000. She literally more than doubled her money in less than 2 years, entirely because she bought when there was blood in the streets and fear was at its absolute peak.
Now, I know it's easy to look back and say they made the right choice, but how do you actually execute this in the moment? Let's get into Section 4, the investment playbook, executing the strategy.
I want to give you the practical, step-by-step strategy so you know exactly what to do when the next inevitable crash happens. First things first, we ground our strategy in the completely mundane, you should be buying index funds. This is a single, boring investment that automatically tracks hundreds of the largest companies out there. You do not need to try and pick individual stock winners, and you definitely don't need to day trade. When you buy an index fund, you are simply betting on the overall long-term growth of the American economy. And over the decades, despite wars, recessions, you name it, that trend is always going up. Next up, we use a process called dollar cost averaging. You don't just dump all your cash in at once. Instead, you divide your capital into chunks, let's say 20% portions. You invest that very first chunk immediately when you see the market dipping into fear territory. Then, you just invest the remaining chunks monthly over the next 6 to 12 months. This method is amazing because it completely removes the stress of trying to perfectly time the absolute bottom of a crash, which, let's be honest, is completely impossible anyway. If the market goes lower, great, you just get to buy at an even better price next month. Finally, let's rapidly run through our strict rules of engagement. These are completely non-negotiable if you want to protect yourself from panic selling. Rule 1, only invest money you definitely won't need for the next 5 to 10 years. Seriously, this isn't rent money. Rule 2, stick to those well-diversified index funds. Rule 3, never borrow money to invest unless you have a rock-solid, mathematically sound way to pay it back from your stable income, kind of like Alex did. And Rule 4, ignore the daily news cycle. Just turn off the TV, stop obsessively checking your portfolio every single day, and let compounding do all the heavy lifting. Look, the data is incredibly clear here. Every single generation gets a few of these moments where the market serves up unbelievable opportunities simply because the crowd is absolutely panicking. The only variable is your own mindset. So I'm going to leave you with this final thought. When the next crash inevitably hits, are you going to let fear completely control you, or will you use it as your ultimate buy signal? The choice is entirely yours, but the time to mentally prepare is right now. Thanks so much for joining me on this explainer, and I'll catch you next time.